Okay, today we're going to be answering the most asked questions in seller financing. So we're going to jump through these really quick. So the first one is, what is seller financing? How does it work? Seller financing is when the seller is the bank. You're not going to a bank like a credit union. You're not going to a lender. The seller is the bank. You have a promissory note. Typically, the loan, the note is secured against the property in real estate, the property or which asset or thing you are having secured. So for example, if I go to buy a property and it's seller financed, a note will be recorded on the actual property. So the property is collateralized and I get the property, and that is how it's protected for the seller. So why would a seller offer seller financing? One, to attract more buyers. Because if you're having a hard time selling a property or you want to be able to turn it into another asset, the loan that the seller sets up is an asset for them. Because if I sell you a property and it's a $500,000 loan, you're going to be paying me that $500,000 interest, whatever payment we set up, every single month or year or quarter, whatever it is, every day potentially. So you can set up whatever terms you want, but that loan is an asset. If a business wants to sell, they may seller finance it because it's a lot easier for them to sell to somebody because that buyer may not be able to get a loan for the full amount or a loan at all. So it creates that passive income for them. It's an asset for the seller. You can also create a scenario where the capital gains, it's not just that they're deferred, it's just that you can break up the amount that you're going to be getting a hit each year for capital gains. And that's important to understand because if you go in and have a capital gain, then let's say if you were to just do an outright sale, there'd be $1 million capital gain. Well, that capital gain can actually be broken up now over 10 years, for example. So there's different ways that you can do that, but there are tax benefits to sellers. Why would a buyer choose seller financing over a traditional mortgage? So the real big piece to this is with seller financing, all of the terms are negotiable. So you're taking a buyer, you're taking a seller, and they come together. And the terms, as long as they can agree on them, then you have a deal. I've had seller financing notes that are interest only. I've had seller financing notes that are no interest ever. They're just principal only payments. There's different ways to set it up, but in the end of the day, the creativity, the ability to set up a deal that you wouldn't be able to set up otherwise. There's also the side that it's possible buyers don't qualify or the property doesn't qualify for traditional financing. One example is non-warrantable condos. So non-warrantable condos, they can be hard to finance where you need a large down payment. That could be an opportunity for a seller to come in and seller finance it. You run into the same thing with mobile homes, with hospitality, with condo hotels. There's a lot of properties that fit inside that bucket. Why would a buyer choose seller financing over a traditional mortgage? That's the one we just covered. What are the risks of seller financing for a seller? So the buyer could default and then you have to foreclose or do an eviction. The property could be damaged by the buyer if they don't take care of it. That's actually a really good opportunity because as you build a good reputation, you can go to other property owners and say, so-and-so seller finance to me, and I went and improved the property, right? Like I'm always looking for opportunities to do value add, especially in like mobile home parks. So I'll go buy a mobile home park or do a value add opportunity. Just did 2 asphalt roads yesterday in these parks. That improves the asset. So the seller feels more comfortable because now they're seeing that the asset's getting better. So if they had to take it back, they know that there's capital improvements that now justify a higher value. What are the risks that a buyer has in seller financing? All terms are negotiable. So you might have some terms that are more expensive than traditional financing. You might have a balloon payment. That's pretty common after so much time. And just like any other loan, if you don't pay, they're going to take it from you. So is seller financing legal in all 50 states? Seller financing is legal in all 50 states. What you're going to run into are different regulations that may impact the way that a loan is set up. Dodd-Frank has some regulations as well. What you need to be aware of with Dodd-Frank is that that's federal, so that's nationwide. So look at the lending rules in that specific state and make sure that you're aware of how to set that up as you're working on the terms. Do you need a lawyer to do seller financing deal? You do not. I would say that it depends on the state because some states, lawyers do the title work. And in other states, like here in Utah, we go get title companies and it's a little bit different, but I don't use attorneys for them unless it's a big deal. And so what ends up happening is the title company does all of the paperwork and they put it together and we get clear title and we move forward. So no, you do not need an attorney. The smart thing for me to say though is that you should always consult an attorney when it's anything legal, right? Anything legal, anything that that you may be unsure about. It's not bad to have a real estate attorney in your back pocket. I personally do deals all the time without an attorney drafting the documents. Being a licensed broker in the state of Utah, that might be part of the reason why also, because I have documents that allow me to do seller financing. So how do taxes work? The sellers should be providing a 1098 tax form that shows the interest paid. They should be providing that at the end of the year that the buyer can use for their taxes. So that's not a super complicated question, but you should get the normal tax benefits that you would get on any transaction during that. So who holds title in a seller financing deal? Again, it's going to depend on the terms. I hold title, but when I seller finance my manufactured homes, I'm holding on to the actual title because it's more like a car title. Where real estate, it's different, right? Like you have your deed, right? Like it's a little different. In most cases, especially for real estate, the buyer is going to be holding on to that, and the seller holds a lien on the property. So it's going to depend on the state laws and what they require, but that's typical. The buyer gets the deed at closing, and the seller holds a lien. So how is seller financing different from rent to own? The biggest difference is that with rent to own, you don't own the property. You have an option to purchase the property with certain terms, and with a seller financing, you actually would get the deed as the buyer. So that's the biggest difference. I would say also like tax benefits are going to be different as well. Like your interest payment, if you want to write it off, you need to own the property. Sometimes rent to own will give credits towards the principal or towards a down payment. So that's something to keep in mind as well. How do you structure a seller finance deal step by step? So you're going to be negotiating the terms. So price, interest rate, down payment, your monthly payment, all of that. And there's many more pieces to the terms, but I'll keep it simple. Then you have the outline. So you're going to draft the promissory note, which is going to be the security instrument of how you record the lien. And the reason that's important is that's reflecting all of the terms that you've negotiated on with the seller. Then those documents are recorded at the title company, and the documents and the purchase contract are all executed. So that's an overly simplified version of a seller finance contract. What's a promissory note and why is it important? So it's a legal document where the buyer promises to repay a loan. You don't need to have a promissory note on real estate. Promissory note can be for anything. It doesn't have to be real estate. It's a better way of saying it. So it outlines the loan terms, the loan amount, rate, payment schedule, penalties, that kind of stuff. It is enforceable and can be sold or assigned to others. So that's pretty cool. That's an actual asset. Like I said before, you could go and get a seller finance deal put together and then sell that loan to somebody who just wants to get paid every month and wants the loan as an asset. Okay, what is a wraparound mortgage? How does it work? So you've probably heard Pace Morby doing this a bunch, but basically the seller has a mortgage in place. Ideally, it's at a low interest rate. That's what makes it appealing. And what you end up doing is you wrap that mortgage, you use an all-inclusive trust deed, and the new buyer takes over that loan. Now, there are some risks with that because there are some triggers that may call a note due unpayable, a due on sale clause. Be aware of that risk, set it up. Again, I would say consult with an attorney, right? And there are attorneys that specialize in wraparound mortgages. So the buyer makes one payment to the seller and they pay the original lender. I've also seen buyers that take over the payment entirely and they just jump into the bank account and they make the payments. They switch out the bank account. It's just auto draft every month. So this usually happens when you do a wraparound because they have a low interest rate. I did a wraparound on a purchase, me as a buyer, with a partner on a property here in Utah, and it was a 3.5% interest rate. Well, that's a low interest rate. So there are benefits to that. Hey, what is a subject to deal versus seller financing? So subject to, it means the buyer takes over payments on the existing loan. So they're doing the wrap, right? Financing, I wouldn't say that one is like this. So just subject to isn't seller financing because I think it's a form of seller financing, but it can be riskier because of that due on sale clause. So you just need to be aware of that. Okay, how do you find seller finance deals? So a lot of it's motivation. Where are sellers posting properties and showing that they're motivated? So this is important because if a property has been on the market a long time, the seller may be more open to it. Landlords that are getting older, tired owners that are retiring, properties that are going into default. I have not done direct mail, but people do direct mail. What I will tell you is I have found properties on Facebook. I have found seller finance properties by calling comparable property owners from an appraisal report. My first, I got one, it was on a Facebook group. Somebody said, how do you sell a mobile home park? And I said, talk to me. That was my best seller finance deal that I've ever done. It was in a Facebook group. There's pages like Craigslist and KSL, MLS. There's so many opportunities. What I will say is there's more opportunities to do seller finance deals than there are people to do them. I 100% believe that. And if you can go in and be committed to finding those deals and being a good operator, it's like walking into a buffet. There's an endless amount of deals that you can find with low interest rates, better terms, and in many cases, zero down. So there's no excuse if you're trying to get into real estate as an investor. I mean, everything comes down to time, money, and skills. Most new investors have time. They have some skills, but a lot of them don't have money. So it's either partnering up, working and getting some money, or you find sellers who are willing to sell on the terms of zero down or low down payments. So how much down payment is typical in seller financing? The down payment, it really depends. I've paid zero down all the way up to 30%. But I will tell you, the 30% that I paid down, I got 0% interest. So my debt pay down is a return of nearly 60% over 3 years. 60% return on our down payment. That's not taking into account all the other benefits like tax write-offs and cash flow and all of that, which we have. Yeah, lower down payments can be offset by higher interest rates. It's a balancing game. You can just take one thing and adjust it. So that's really important to understand that seller financing it's not playing checkers, it's playing chess. What interest rate should I expect? This just depends on the overall terms. If it's zero down, get a higher interest rate. Get a higher interest rate and get interest-only payments, right? I mean, it's just different ways to do it. A lot of sellers are so fixated on price, they're willing to give you a lot of great terms if they can get their price. But you can always offset it with other pieces, other terms. Can seller financing have a balloon? Yes, you can have a balloon. Most of the time, you're 3 to 5 years, but you can have a balloon. I have loans that are also fully amortized over 30 years. So you don't have to, but when that comes due, you either need to refinance or sell. Can I refinance out of a seller finance deal later? Yes, you can. Let's see. Yeah, so do I report seller financing to the IRS? It's just like seller financing is a normal mortgage. The only difference is we're so used to looking at banks as a mortgage company and that being normal that we forget about the fact that for tens of thousands of years, people were seller financing deals. You weren't going to the bank. You were talking to Mr. Farmer and saying, hey, Mr. Farmer, Mr. Hunter, Mr. Merchant, I don't have enough money for this, but I'm willing to do this, right? I mean, that's how lending was done. It was private. It was, person to person. And I think bringing more of that back would be good for the economy, good for the country, and good for each and every one of you.